Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we are looking at Bitdeer Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
Right, so Silicon Valley has this almost unlimited budget for artificial intelligence right now. I mean, the biggest tech giants on the planet are just throwing billions of dollars at software, building smarter algorithms, and, training these massive language models. But they're running face first into a brick wall.
Yeah, they are completely running out of the one physical thing they actually need to make it all work, which is electricity.
Exactly. I mean, imagine a traditional gold mining company that spent years out in the freezing wilderness, right? They poured all this blood, sweat, and capital into navigating local zoning laws, laying miles of high-voltage cable.
And building sprawling electrical substations just to power their heavy digging machinery.
Right. And then one day they look around and realize their most valuable asset isn't actually the gold they are pulling out of the ground. It is the electrical grid itself. Because suddenly, the biggest tech companies in the world are knocking on their door, desperate to rent that exact power.
Yeah, and today we're looking at a company that is living that exact scenario, attempting to pivot from a pure-play crypto miner into an artificial intelligence powerhouse.
It is a massive structural pivot. When you look at the artificial intelligence revolution, the ultimate bottleneck is no longer the code.
Right, it's the infrastructure.
Yeah.
You can have the most advanced, brilliant AI model in the world, but if you don't have the literal gigawatts of power to train it and cool the servers, it's just, theoretical math sitting on a hard drive.
Just sitting there, yeah.
Exactly. That physical reality is why this specific transformation is capturing so much attention.
All right, let's move into the wealth building context. Because understanding the broader landscape is really crucial here. I mean, the story of wealth generation often comes down to owning the pickaxes during a gold rush. But in this case, it is about owning the power lines.
Exactly. To understand the long-term wealth potential of this stock, you really have to look at the economic moat they are building.
Right. And a moat is just a fancy way of saying what prevents competitors from immediately copying you.
Yeah. And for Bitdeer, that moat is quantified by a staggering 3.0 gigawatts of total global electrical capacity pipeline, with 1.7 gigawatts of that already online and energized.
We throw the word gigawatt around a lot in the tech and energy space, but let's ground that for you for a second. A single gigawatt is roughly the amount of power it takes to run a mid-sized American city. And they control 3 of them.
3 of them, yeah. And that scale is why traditional data center operators can't easily replicate this playbook. Right now, hyperscalers, the massive cloud providers running AI workloads, are facing multi-year wait times just to get their hands on a fraction of that kind of grid power.
Because if you want to build a new data center today, you have to find land, get environmental permits, and, most importantly, sit in an interconnection queue with the local utility company that can take, 5 to 7 years?
Easily 5 to 7 years.
Yeah.
But Bitdeer already jumped that line years ago for their crypto operations. Having energized sites ready to go gives them this insurmountable competitive advantage in speed to market.
Now let's look at the fundamentals, because narratives about economic moats are great, but we need to know if the financials are actually reflecting this reality, or if management is just, slapping the letters A and I onto their press releases to juice the stock price.
Right, the AI hype factor.
Exactly. But the financial inflection we are seeing is actually pretty staggering. Let's walk through it. In 2024, their total revenue was $349.8 million. In 2025, it surged to $620.3 million.
Wow.
And the fourth quarter alone generated $224.8 million.
I mean, revenue growth is a strong signal, but in the notoriously volatile crypto sector, we really have to scrutinize the bottom line. Generating cash is entirely different from keeping it. So in 2024, they posted a massive $531.9 million net loss.
That is a huge hole to climb out of.
It is. But by the end of 2025, they swung completely around to a $70.5 million GAAP net profit.
Let's pause there and decode that for anyone who isn't staring at accounting spreadsheets all day. GAAP stands for Generally Accepted Accounting Principles. It basically means this isn't just creative math or adjusted numbers where a company, hides its bad debts.
Right. It's the standardized, heavily regulated way of reporting that shows they legitimately turned a real profit. That is a crucial distinction. Furthermore, their adjusted EBITDA turned positive, hitting $31.2 million.
And EBITDA earnings before interest, taxes, depreciation, and amortization is a metric we use to strip away accounting quirks and look purely at the cash flow generated by the core day-to-day operations, right?
Exactly. So hitting a positive $31.2 million tells us the mechanical engine of the business is functioning efficiently.
But the data point that absolutely jumped out to me is what is happening specifically inside their AI cloud segment. Fast forward to March of 2026. The annualized revenue run rate, their ARR, basically projecting their current monthly sales out over a full year, hit approximately $43 million.
Yeah, that is a 105% month-over-month increase from February.
It's crazy. And they reported that their GPU utilization skyrocketed to 94%. Now, you might be looking at that 94% utilization and thinking, wait, are they hitting a ceiling? If your factory is running at 94% capacity, you are basically out of room to grow, right?
It's a completely logical concern, but the mechanism behind that 94% tells a totally different story. It isn't a sign of stagnation. It actually reflects a deliberate shift in their business model.
How so?
Well, in cloud computing, you can sell what are called spot instances, which is basically renting out compute power by the hour to whoever walks in the door. It's high-margin, but totally unpredictable. Instead, Bitdeer is aggressively locking their capacity into mid to long-term contracts with robust AI agent workloads.
So it's the difference between running an Airbnb where your income fluctuates every weekend versus, signing a 5-year commercial lease with a stable corporate tenant.
That is the perfect analogy. The core of their historical business mining Bitcoin is wildly volatile. Your revenue is entirely at the mercy of sudden drops in the price of Bitcoin.
Right.
So by shifting their AI infrastructure into these long-term contracts, they're pouring a foundation of highly stable, predictable revenue. It serves as a financial ballast to offset the wild swings on the crypto side of the ledger.
That makes total sense. That brings us to the catalyst timeline. Knowing the underlying fundamentals is only half the battle here. We need to identify the specific upcoming events that will force the broader market to wake up and reprice this stock. What is on the calendar for the next few months?
The immediate hurdle is their first quarter 2026 earnings call, which is scheduled for May 14th. Following that, they have a really heady rotation at major institutional conferences throughout May and June, including B. Riley Securities, the Benchmark Digital Asset Summit, and Northland Capital Markets.
Why do those specific conferences matter so much? Aren't they just industry meet and greets?
No, they are essentially a roadshow for survival and expansion. Building 3 gigawatts of infrastructure requires an ocean of upfront capital. These conferences put management directly in a room with the heavy-hitting institutional fund managers who can literally write the checks required to fund their next phase of AI data centers.
Right.
Furthermore, they are making these pitches against a backdrop of potential macroeconomic tailwinds, specifically the possibility of Federal Reserve easing.
Let's unpack that mechanism because macroeconomics can feel really abstract. If the Federal Reserve decides to ease policy and lower interest rates, how does that specifically turbocharge both the crypto and AI sides of this business at the exact same time?
It creates a really fascinating dual engine effect. So let's look at the crypto side first. When the Fed cuts interest rates, the yield on safe investments like government bonds drops. Investors seeking returns are basically forced to move their cash into riskier assets, which historically includes Bitcoin.
Right. And additionally, lower rates often weaken the US dollar. And since Bitcoin is priced in dollars, its nominal value tends to rise.
Exactly. So the 661 Bitcoin they mined just in March suddenly becomes much more valuable on their balance sheet.
And how does that translate to the physical AI infrastructure side?
Well, building massive server farms is incredibly debt intensive. When the Fed lowers interest rates, the cost of borrowing money drops significantly. It suddenly becomes much cheaper for them to finance the heavy construction, the cooling systems, and, the raw steel required to expand.
That is a huge advantage.
It is. But the most significant catalyst on the horizon isn't macroeconomic at all. It's a highly specific, speculative wildcard. Management is currently in advanced negotiations for a co-location AI data center lease at their 225-megawatt site in Tidal, Norway.
A 225 megawatt facility is massive. That's essentially dedicating an entire power plant just to run liquid-cooled AI servers. Why is this one specific lease considered the holy grail for their stock narrative right now?
Because it forces Wall Street to fundamentally change how they categorize the company. If they sign a major AI tenant for a space that massive, it becomes a transformative rereading event. Right now, the market looks at them and says, well, you are a crypto miner with a neat side project.
And crypto miners are assigned very low valuation multiples because their revenue is unpredictable.
Right. But if that lease is signed, it proves the dual-track strategy works at hyperscale. It locks in high-margin, long-term revenue, forcing analysts to start valuing them as an AI infrastructure utility, which commands vastly higher multiples.
Now let's pivot to the chart and look at the technical and operational metrics driving the price action, because part of this story is how they actually build the equipment to utilize that 3 gigawatts of power. The stock is currently trading around $12.61, but the broader consensus target across analysts is $20.78.
That is a huge gap.
Yeah, and a big reason for that gap is their operational efficiency, which is driven by vertical integration.
Right, because most competitors in the mining space are entirely reliant on third-party manufacturers like Bitmain to buy their physical hardware. Bitdeer takes a completely different approach. They actually design and manufacture their own proprietary rigs, like the new SealMiner A4.
And the reported metric here is that the SealMiner A4 operates at an efficiency of 9.45 joules per terahash. For someone who isn't deep in the weeds of semiconductor physics, what does joules per terahash practically mean for the balance sheet?
Think of joules per terahash as the fuel economy rating of a crypto miner. It measures exactly how much electrical energy in joules it costs to generate a specific amount of computing power, a terahash.
Right.
So a rating of 9.45 is exceptionally low, meaning it is highly efficient. By manufacturing their own hyper-efficient hardware, they cut out the massive profit margins that third-party sellers usually charge. It drastically lowers their baseline cost of operations, allowing them to remain profitable even when the global price of Bitcoin drops.
So what does market sentiment look like? Because despite that operational efficiency, we saw a massive headline recently when Cantor Fitzgerald downgraded the stock and slashed their price target all the way down to $10. I have to play devil's advocate here. If the AI pivot is so brilliant and their proprietary hardware is so efficient, why did a major Wall Street analyst look at all of this and slash their target below the current trading price?
It is a valid question, and it really comes down to investment time horizons. Cantor Fitzgerald's downgrade is rooted almost entirely in the immediate short-term pressures on the crypto side of the business. Analysts at major banks are often hyper-focused on the cash flow for the very next quarter.
So they're looking at the current depressed price of Bitcoin and the heavy capital expenditure required for the AI pivot and just modeling a short-term margin squeeze. But the market reaction to that downgrade is what I find fascinating. The stock didn't crater. It absorbed the selling pressure almost instantly and then rallied sharply after their March production update came out, which showed a 480% year-over-year increase in Bitcoin production.
Yeah, that price action is a textbook example of capital moving from weak hands to strong hands.
Let me push back on that phrase, though. Strong hands often just sounds like a convenient excuse investors use to justify holding a stock that is taking a beating. How do we know this is actual institutional conviction and not just, stubbornness?
We know it because we can track the institutional capital flows. When Cantor issued the downgrade, retail traders or momentum algorithms might have panic sold. But institutional investors, the heavily capitalized funds with multi-year outlooks, saw the artificial dip as a discount and aggressively bought the stock, completely absorbing the downward pressure.
Right, the volume tells the story.
Yeah, and the proof is in the insider moves too. Tether, the massive stablecoin issuer, stepped in and bought $42 million worth of Bitdeer stock in February 2026.
Tether manages tens of billions in reserves. When they deploy $42 million into a single mining stock, they aren't day trading. They're acquiring strategic infrastructure assets.
Exactly. The broader analyst consensus remains bullish despite the Cantor note because the market is observing idiosyncratic outperformance. That means Bitdeer is executing on metrics entirely unique to their own operations, like that 105% jump in AI cloud revenue that override the day-to-day macroeconomic noise of Bitcoin volatility.
Now let's talk about the risks. Building massive reservoirs of power and manufacturing your own silicon chips is incredibly expensive. In fact, it is a financial black hole up front. The company currently holds $1.0 billion in total borrowings. That is a billion with a B. And their free cash flow is highly negative. They burned through $599.5 million in operating activities in 2025 alone.
That level of capital expenditure requires deep context, though. The $599.5 million wasn't wasted on inflated executive salaries or frivolous expenses. It was heavily concentrated in supply chain prepayments to manufacture those SealMiner rigs and build out the physical data center architecture.
Okay, that makes sense.
As for the $1 billion in debt, it is primarily tied up in convertible senior notes issued in late 2024 and 2025.
Let's clarify convertible senior notes for you. This isn't just a standard fixed-rate mortgage from a commercial bank. They borrowed money from institutional investors under an agreement that the debt can eventually be converted into shares of the stock, right?
Correct. And that structure introduces a very real risk of equity dilution. If the stock price rises and those bondholders decide to convert their debt into stock, millions of new shares are introduced to the market. That dilutes the ownership percentage of every existing shareholder.
Which is definitely a risk factor.
It is. However, there is a fascinating silver lining hidden deep in the accounting of those notes. The financial reports show a $208.9 million non-cash gain on fair value changes of derivative liabilities.
That sounds like a symptom of a very aggressive accountant. Walk us through how a company claims a $200 million gain without actual cash changing hands.
Right. So because convertible notes are tied to the stock price, their liability value fluctuates on the balance sheet. If the market conditions shift favorably relative to the strike prices of those notes, the company records a paper gain. It is an accounting quirk, but it dramatically improves the optics of their balance sheet health.
But the financial engineering doesn't protect them from the physical elements. The operations are heavily exposed to seasonal weather risks. In March, they had a total global capacity of 70 exahashes per second, but their actual realized hash rate was only 47.4.
Wow.
Yeah, they were missing nearly a third of their compute power because of seasonal hydro availability issues in Norway and Bhutan. How does the weather directly shut down a server farm?
Well, in places like Norway and Bhutan, their massive electrical draw is supplied by hydroelectric dams. When those regions experience severe dry seasons or deep winter freezes, the water flow drops significantly. The dams physically cannot produce the maximum megawatt output.
And when the power grid output drops, Bitdeer literally has to power down sections of their mining fleet.
Exactly. Couple those weather shutdowns with a depressed Bitcoin hash price, which is currently squeezing margins down in the low $30 per petahash range, and you see exactly why Wall Street analysts get nervous about the short-term cash flow.
So with everything on the table, what's the final verdict?
Based on the aggregated institutional analysis, the stock holds an 8 out of 10 bullish score. It is fundamentally viewed as a medium-term hold, looking at a 6 to 12-month horizon to allow these AI catalysts to materialize.
What the market is offering right now is a potentially asymmetric entry point. You are looking at a company attempting an incredibly rare and difficult maneuver, successfully bridging the gap from volatile crypto mining to high-margin, predictable AI infrastructure. And they are doing it while holding a 3-gigawatt power pipeline that is virtually impossible for a new competitor to replicate today.
It is a remarkable structural transition. And honestly, it points to a macroeconomic shift that goes far beyond just one company's balance sheet.
It makes you wonder, as these 3-gigawatt power centers become the literal physical engines of global artificial intelligence, do companies like Bitdeer stop being evaluated as traditional tech stocks? At a certain scale, they start looking more like critical national security assets. If the entire global economy is going to run on AI, and AI requires an unbelievable amount of electricity, if you control the power grid, do you eventually control the outcome of the AI race?
That is the multi-trillion-dollar question. The technology industry spent the last 20 years obsessing over software. The next 20 years will be defined by whoever owns the physical plug.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We will see you in the next Smart Wealth with Joshua episode.